Hello investors and future investors, welcome to the channel. For today's video, I'm going to show you how to trade United Health. Now, if you're tired of your 9 to 5 or you're trying to make some extra money to add to your 9 to 5 and you want to do that by using options from your house, then you definitely stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to trade United Health and how you could make some massive gains if done correctly. Now, if you're new to options trading, I will try to make this as simple as possible in order for you to know how to follow along. If you're also new to options trading, you should probably check out some of my other videos before watching this one. Now, United Health has been in the news as of late, but that does not matter because we're options trader and we have a long-term outlook. So that being said, that is how we decide what option strategies we want to use in order for us to make our gains. Now, before I get into this, I require two things from my viewers and my subscribers. Quite simple things. Number one is going to be always make sure to do your own due diligence before investing. What might work for my portfolio might not work for yours. The second thing is going to be always make sure to have an exit strategy. If anything goes wrong, then you should know what to do. Now, let's go ahead and get into it. Now, for those of you new to options, I'm going to go ahead and do some basic technical analysis before we get started, before I show you what options in order to do to make money with this stock. So let's go to the Robinhood Advanced feature right here. Let's go ahead, open that up, and that's going to open up our chart. What we're going to do now, we're going to go to the 1Y here, which represents the 1 year outlook. Now, what I look for is in the chart is to see where the actual stock price is trading. Now, the stock price is trading at $299.50, which is close to the $300 mark. However, you see this blue line right here. This blue line is known as the MA200 or your 200-day moving average. Okay, so I usually use this blue line here to get a gauge of where the share price should be trading. So according to this, it should be trading around $541. That's where it should be trading. Currently, as according to the graph right here, you could see it's closer to the $300 mark, which is a huge gap. Now, I'm going to go ahead and look for secondary confirmation like I usually do. And for that, I'm going to go ahead and check out my RSI. And once again, you could get all those things right here on Robinhood. You don't need to go anywhere else. So the RSI is right down here. And for those of you who do not know, this is the relative strength index. And it's pretty much a momentum indicator to tell us where the stock price is going up or the stock price is going down. Now, according to this RSI, United Health is trading close to the 30 RSI, and that's incredibly beautiful. Let me tell you why. When measuring the RSI, we usually look for a range between 70 to the top and 30 to the bottom. With any stock going towards the 70 RSI tells you that the stock is in overbought territory and vice versa. Now, United Health is smack at the bottom at 30, so that is beautiful. The reason why I say it's beautiful is that this gives you an extremely brilliant opportunity in order for you to start trading this stock. Now, the last time I saw a setup like this, I did make a video about it and we walked off with $1,500. Let me just show you that setup right here. And that stock was TTD, none other than Trade Desk. So here we have it. Right here, you see this stock also tanked right down. We were able to get in at the $50 mark right here. And then we were able to get out right around the 70 mark here, and we were able to lock in $1,500. Now that I see this opportunity with UNH, United Health, then I just kind of let it pass by. So what we're going to do now, based on the 200-day moving average, the current share price trading way below the 200-day moving average, and an RSI of 30, that's going to tell me what options I want to use for this stock. So let's go ahead and get into that now. So to get this started, what we're going to do, we're going to go to trade UNH down to the bottom in order for us to open up our options chain. Now, the option chain is all this information right down here. And what this information does is that it gives you enough information in order for you to make a very informed decision of what options you want to get into. So if I were trading UNH right now, this is what I would do. I'm going to go to buy, I'm going to go to call, and I'm going to choose a long dated strike date. So I'm going to be going with September 19th which gives me 124 days to expiration. The reason I'm going with September 19th is because I am of the mindset that this share price is going to go back up way before that time. The whole point of getting September 19th is that I want to give myself enough time in order for me to be right. Now that I have buy and I have call and I have chosen my strike date way out, I'm going to go ahead and choose my strike price. Now, I did show you that the RSI is at 30, and at the 30 RSI, it's around the $300 mark. So I'm going to go ahead, I'm going to choose the $300 strike price. Now, this is a buy call, so that means you're going to have to pay some money. The amount of money you're going to have to pay is going to be $36.95. Now, in the real world, that's going to work out to be $3,695. So if you are trading with a small account, you should be able to afford this. The reason why I'm going with the $300 strike price is because I'm extremely bullish on this. And I just showed you my two indicators that give me secondary confirmation. Now, one thing I really want to bring to your attention is this 54 delta here. Let's round it out to 55. Now, when doing options, no matter whether you're buying or you're selling options, Delta has a very pivotal role to play. And I'm going to show you how much money you could make just by using the Delta. So once you do that, you're going to go ahead, you're going to click into the $300 strike price, and there you have it. This is pretty much a long call. Now, once you have the long call in your portfolio, here's what you're going to do. You're going to do absolutely nothing. The whole point of getting a long call is because you're bullish on the stock. All you need in order for you to make money is to be bullish on the stock and just have some patience. That is the only two criteria you need. So you buy the long call and you wait it out. You have more than enough time to make any adjustments if adjustments need to be made. Remember, always have an exit strategy. Okay, so now all we're looking for is for UNH to go back up to $350 price, which is going to be right here. So let me just show you that on the chart. Okay, so here we are back on the chart, and this stock actually moved from a $600 stock all the way down to $300. Now, you can go ahead and buy a leaps option on this, which is a long call. Or if you don't have enough money, you could simply do the long call I just showed you. And only thing you're looking for is this stock to go to 350. That is it. That is not much. That's not much to ask. So let's go ahead and get back to our previous option. Okay, so here we are on the previous option. And like I mentioned, all we need is for the stock to go to $350. When that happens, and yes, when that happens, this is how you're going to make money. So now that you're buying the stock, it's close to $300. So let's just round it up to $300 strike price. Once the stock go ahead and moves to $350, the amount of money you're going to be making is a difference between the $350 and the $300. So that's going to be $50. Now remember, you are dealing with options here. So your gross amount is going to be your $50, which is the move, multiplied by 100 shares. So that's going to be $5,000. But remember, that is going to be your gross return. Now, the other thing you're going to do, you're going to now multiply your delta, which is 0.55, which we just mentioned before. We're going to multiply that by your $5,000 gross. And that's going to net you $2,750. And that is how easy it is to trade this stock. Now, like I mentioned before, this is going to work out perfect if you trade with a small account. You should be able to afford $3,695. Now, like I mentioned also, if you do want to give yourself way more than enough time to get this done and you want to implement a different option strategy, then here's what you could do. We're going to go and change our strike date right now. And we're going to go to March 20th, 2026, which gives us 306 days to expiration. Now, because we're going further out, it's going to be a bit more expensive. So as you can see here, we're going to stay with the $300 strike price. That strike price is a very nice strike price. So we're going to stay with that. But this time, we're going to have to pay $52.75, which is not that much. However, now that you give yourself more time, you could now go ahead and implement another strategy. This other strategy is what's going to be known as the PMCC. So by buying this long call out, this is going to be what's known as a leaps option, which stands for poor man's covered call. Ideally, a leaps option is a long call that's 365 days out or more. So the 306 is pretty close to the 365. once you have the leaps option in your portfolio, now you could go ahead and do the second part of the PMCC, which is going to be selling covered calls. And to do that, you go to sell, you go to call, and then you're going to choose a closer expiration date now. So the expiration date we're going to go with May 12th because we're going to be doing bi-weeklies on this. Bi-weeklies means you want your option to expire every 2 weeks. And then now we're going to go ahead, we're going to choose our strike price. Now you got to be very careful with the strike price. The strike price we're going to be choosing is going to be the 455 strike price right here, which gives you a 98, or let's round it up, a 99% chance of profitability. Now, for that 99% chance of profitability, you're going to be getting 0.28 or $28. $28 waiting for 2 weeks is well worth the wait. Trust me on this one. Now, the reason why I chose the 455 and I have such a high percent chance of winning this trade is because this share price will go up. It's almost guaranteed. You do not want to get caught choosing a lesser strike price and get way more income, and then you're gonna now lose your leaps option. So make sure you choose a very, very high strike price because this share price is gonna go up. It's almost guaranteed. So there you have it. If I were to trade United Health right now, these are the options I would be getting into. I would buy a long call expiring September at a strike price of $300, and I'm going to leave it in my portfolio and do absolutely nothing. I'm just going to wait for the share price to appreciate. Then I'm going to lock in my investment gains. The second strategy I would use with this, I would choose a longer long call or a leaps option in order for me to be able to sell covered calls. Those two together is what's known as the PMCC or the poor man's covered call. Now, if you guys got any value from this video and you guys interested in growing a small account portfolio, then I do offer one-on-one coaching. The link is going to be in the description below. Now, go ahead, like the video, subscribe to the channel. Go ahead, hit the notification bell to get an alert whenever I post a video. I do post pretty often, but most importantly, if there's anyone out there you know struggling to grow a small account portfolio, well, that's what we specialize in. So the only thing to do is to go ahead and share this video with them. And until the next video, keep pushing your investments.